This report brought to you by the Richmond Club, where investors and high-growth companies meet.
Good afternoon, gentlemen, and welcome. Our first speaker today is Chris Dobbin, the President and CEO of Nova Leap.
So I founded Nova Leap Health Corp back in 2016, the early part of 2016, through the CPC program. So we seeded our own shell. We didn't do an RTO, but we seeded a clean shell. And since the latter part of 2017, we've been fairly active on the acquisition front. In September of 2017, we made an acquisition in Rhode Island in the U.S. A couple weeks later, we made an acquisition in Vermont, which also had a location in New Hampshire. In February, we acquired a business in Massachusetts. In April, we acquired another business in Massachusetts. In June of this year, we acquired a Halifax-based business. And then in September and October of this past year, we acquired two businesses, both again in New England area. So we've been focusing fairly heavily within New England and in Nova Scotia. Lots of runway for us to grow, but that's been the evolution of our business. If I was standing in front of you a couple years ago, you'd probably ask, why are you a public company when you're so small? My view was that the market is so fragmented and there's such a demand for the services that we could provide terrific care within the home. At the same time, we could grow a very large multinational home care services organization. So we're at the very, very early stages of doing that. And we've gone from essentially zero revenue when we first seeded the shell through the CPC program to effectively a $15 million US revenue run rate in that time period. So our growth has been, even though we're a small company, has been quite significant over the last year and a half. So what do we do? We often hear home care versus home health care. Home health typically refers to nurses, so medication administration or wound care oftentimes, palliative care where there's pain management and so on. Home care, which tends to be the bulk of our business on the non-medical side of things, really for us is focused around dementia care. We have north of 60% of our client base has some form of dementia. And so that's really where our focus is and where our training is and where we invest our training dollars and expect to in the coming years. We also provide companionship for an individual that has lost a loved one and just wants someone around for support. Mobility issues, transportation, personal grooming, medication reminders, errands, and so on. So, there's a lot of non-medical assistance we can provide that will allow someone to remain in their home. And one of the questions I often get is, how do you compare home care versus going into, say, an assisted living facility or a nursing home? And my answer has always been, we may be able to provide 9 or 10 or 11 hours a week in the home such that they wouldn't have to go to a facility type setting. And what the research shows is that most people want to remain in their home. 85 to 90% of folks want to remain in their home. They've raised their kids there often. Their memories are there. They feel comfortable there, and so that's really the assistance that we provide, and we'll continue to provide in the coming years. What's the size of the market? Again, one of the fastest growing industries in Canada, the U.S., which is where we focus. It's a roughly $90 billion market overall within the U.S. based on stats that are a couple years old now. I'd personally multiply that by 2 or 3 to take into consideration the fact that the majority of home care is actually provided by unpaid family members. Right? You think about you're looking after a loved one, whether a parent or an aunt and uncle or another family members. I mean, it's often the unpaid family members that are feeling the bulk of the work, and oftentimes also raising their kids at the same time. So we're often called to provide what we call respite or assistance when someone has been burnt out because they're really looking after a couple of different generations of their family, and that to us is a fairly rewarding experience to provide assistance. What's driving the opportunity? Obviously, our focus has been primarily in the U.S. A part of that has to do with the size of the market. It is a very, very fragmented market. There are tens of thousands of these companies across the U.S. and Canada. I don't believe during my lifetime we could ever run out of clients or expansion opportunities. I think the need is so great now and will continue to be so great that this is just a business that will continue to grow. And there's really been nothing over the course of the last couple of years that has changed my mind. That was what I believed when I started the company, and I, if anything, has been reinforced over the last couple of years. I will say that our model, if we look at Canada and the US, is a private pay model. So the bulk of our clients are paying out of pocket. Right, so that's either those we provide service to or the adult children are footing the bill. So we've not gone after Medicare or Medicaid reimbursement in the U.S. We do have we do get reimbursement through Veteran Affairs, again both in Canada and the U.S., as well as long-term care insurance. We also accept that. So the three main drivers from us from a reimbursement or payment perspective, if you will, are really private pay, Veteran Affairs, and long-term care insurance. So we're not subject to some of the changes that often happen within the Medicare and Medicaid reimbursement areas that can often get quite complex and that can change depending on the political situation during the day. So when we take a look at our model overall, typically we're billing anywhere between $23 to $28 an hour. That's typically what we're billing. We've reported gross margins roughly 30 to 36%, and the businesses we look for when we acquire them, and I'll show sort of how we pay. But typically, we're in a situation where roughly half the business would be 0 to 20 hours of service a week, and the other half is 20 hours plus. What we're not looking for is a business that may be doing a lot of revenue, but has a lot of 24/7 clients. While that can be, you can make a lot of money financially on that. Typically, the clients aren't going to be around as long because there's a reason why they may need such a concentrated period of assistance. So the bottom part of this graph will just show sort of the evolution of our revenue. Again, you'll see a couple of years ago, even in Q3 of 2017, we reported $170,000 US of revenue, right? Very, very tiny, and today we're approximately $15 million revenue run rate. So again, our growth, even though we remain a small company, has been quite significant. Q3 results, I'll skip over that because that's available in the slide deck, which can be downloaded from our website. There's three main drivers of our growth. One, we'll continue to make acquisitions. That'll form the bulk of what I would consider to be short or midterm growth. It's very much top of mind these days. At any given time, we're in discussions with a number of different parties, but we do plan on making acquisitions in 2019, similar to what we did in 2018, and we just announced that publicly. Organic growth remains a focus of ours. I do believe that we can achieve double-digit growth organically this year, really through a combination of billing rate increases in areas where I think they're below market, as well as an increase in serviceable hours. So, we're very focused on organic growth. Otherwise, quite honestly, we wouldn't buy a company if we didn't think we could grow it and expand it throughout a state. Our sort of way of operating, or our view of the world, is that we'll typically make an acquisition in a state or a province as a foothold into that state, and then look to expand out throughout that state or province. And if you take a look at where we've been making acquisitions, it's typically been in what are referred to as secondary markets or more rural areas. So it's not been to go into the large urban centers, with the exception of Halifax, which I wouldn't consider to be a very, very large city. So it's a strategy that's worked well for us. We think we can get access to great caregivers, great referral sources, quite honestly great staff that work with us. The circle on this page really just shows where we are at the top right hand side. So again, we're in New England, New Hampshire, Vermont, Rhode Island, Massachusetts, and obviously Nova Scotia, which is not on here. The most competitive states for our industry tend to be the Sunbelt states, California, Arizona, and Florida in particular. Again, we've tended to avoid the more competitive areas. I do have a slide here in terms of where we plan on growing organically. So we have two states that are up here, Vermont on the left and New Hampshire on the right-hand side. The purple dots would be those areas where we currently provide service. You can see there's 4 locations, and then the orange or reddish dots are areas where we believe we can expand. And an expansion for us organically can often be opening a new office in, say, a medical arts building, hiring a licensed practical nurse or RN to provide support within that area, and that's sort of the starting point for us in terms of how we grow. So it's a fairly low risk proposition for us in terms of how we can grow organically in different geographical areas that we don't currently service. Our current portfolio is 2 slides here, but it really, I wanted to show how we purchase businesses. It's typically 2 financial metrics that our investors are looking for. The first is the multiple of EBITDA. We tend to pay between 3.5 to 5 times EBITDA. We've been fairly consistent in that. And the second is a multiple of revenue, or last 12 months revenue, which tends to be roughly 50 to 70% of revenue. Again, it all depends on the profitability and the growth profile of the business, but we've been fairly consistent there. One of the chartered banks in Canada provides us with debt financing because we're buying businesses that typically have a 10 to 15-year track record, that are historically profitable. They can cash flow, and we can apply leverage. So we do have a Canadian bank that's been a tremendous supporter of ours. We've done private placements, both brokered and non-brokered, as we've raised monies for acquisitions, which has gone well. And we typically either have an issuance of treasury stock, which we've done in one instance, or a vendor take back or promissory note. So that tends to be the way in which we structure our deals. Again, keeping within the parameters of sort of that 3.5 to 5 times multiple. The management team, I have a background obviously in an ownership in a home care business, which is how I got started within this industry. I'm a CPA by background, and at one point had my own private capital markets investment bank, so very familiar with transactions, which I think is important here given the number that we're doing. Megan Spittles, our CFO, has been fantastic for us as we've been building out this business. There's 4 directors, I'm one. We have 3 independent directors, Dana Hatfield, who is a CFO for Gold, Michael O'Keefe, who is the CFO for a private business, and Wayne Miles, lawyer by background, successful entrepreneur, and he was also has past experience through volunteer board chair at the national level for VON Canada. Our cap table, we've got roughly 60 million shares outstanding. We do have a number of options and warrants that have been issued. We actually just issued a set. Our trading price today, I think, is 30 or 31 cents. We just issued options to management team that are at 45 cents, so we did a 50% premium to the trading price, which I think is reflective of our view in terms of how we should treat shareholders. The warrants begin to expire in March of 2019, so in about roughly 6 weeks' time. And I can tell you that I just exercised a bunch of warrants at 35 cents, even though our price is at 30 or 31. So I think evidence of the belief that I have in the direction that we're headed in within the company. At the bottom of the slide, you'll see the Bank of Montreal debt. So again, we've had separate facilities, both in U.S. or Canadian dollars, as we've grown the business. And we do have some shares that are still held in escrow from when we seeded the company through the Capital Pool Corporation program. We are about 40% insider held, so pretty tightly held as an organization, which I think has served us well and will continue to serve us well. When we look at comps, and I use this term loosely because we're looking at very large U.S. public companies. I'm really comparing ourselves to Medisys, LHC Group, and Addus. Now, the difference is they've typically been focused on the government reimbursed area, so the Medicare and Medicaid, whether it's home health or hospice or personal care. They've tended to go anywhere from 16 as high as even 30 times EBITDA, which is quite healthy, obviously, and even up to 2.25 times revenue. Now, these businesses have typically have market caps of 600 million to close to 3 billion now. But if I looked at a Medisys, similar strategy that they were employing 18 years ago, I think it was a 98-cent stock. Today it's over $100. So this is an area that is ripe for consolidation. Ever since we started the company, I'd say we continue to have opportunities that come in front of us, and we've been able to execute on the ones that we think are the ones that will add the most value for shareholders down the road. So I thank you very much for your time, and be happy to take any questions that you have.
This report brought to you by the Richmond Club, where investors and high-growth companies meet.
If you've enjoyed this video, please let us know. You've been watching the Richmond Club Report. If you've just come across this channel, please feel free to subscribe. I'm sure you'll find a lot of interesting and profitable investment ideas around here. We'll see you again soon on the next video. Cheers, guys. Have an amazing and profitable day.